Welcome back to Investing Talk Podcast.
Today we're looking at General Motors. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For General Motors, the immediate investor feeling, it's really been driven by that, phenomenal Q3 2025 earnings report.
Phenomenal is right.
Yeah, it wasn't just good. It was the kind of performance that, it fundamentally shifts the thinking, at least in the short term.
Exactly. And for those of you tracking the numbers, we saw a massive adjusted EPS, that's earnings per share, right? A key measure of profit, come in at $2.80, which just blew past the street's forecast of $2.31. I mean, we're talking a 20.7% beat in the auto sector. That's huge today.
Yeah, a knockout blow, like you said. And importantly, it wasn't just cutting costs to hit that number either. The top line, the revenue, was strong too. Came in at $48.59 billion, well ahead of the $45.27 billion analysts expected. So when both revenue and profit surprise like that, the company's doing more than just surviving.
They're actually capitalizing.
Exactly. Capitalizing on the current demand, even with all the macro headwinds.
And the market, it reacted instantly, didn't it? Back in October, the stock just surged 9% pre-market. That's one of the biggest single-day gains we've seen lately for a major automaker.
It really was. And that confidence, it translated immediately into positive analyst reports. You saw the big banks, Goldman Sachs included, quickly raising their price targets, moving towards the mid-$70.
So what was behind it? I mean, what drove that performance specifically?
Well, the key insight here is why it happened. It wasn't really about sheer volume. It was about the margin structure.
Ah, margins. Okay.
Yeah. GM kept seeing really robust, almost, insatiable demand for its high-margin vehicles. Think about those big trucks, the Chevrolet Silverado, the GMC Sierra.
Well, some machines.
They really are. They generate immense cash flow, even while GM is managing all the costs of this big EV transition.
So the current success is really built on the strength of let's call it the old guard, the ICE business, the internal combustion engine stuff.
Pretty much.
Yeah.
And their operational excellence really shines through here. They they really pulled out significant cost efficiencies from manufacturing, from the supply chain. That makes those profits stick.
Okay, so that single quarter was impressive, but let's look beyond that. What about the foundation, the financial flexibility?
Right, that's crucial. In a capital-intensive industry like autos, especially during a really pricey tech transition like this one, cash is absolutely king.
So how are they looking there?
Pretty solid, actually. GM closed Q3 with a hefty $30.6 billion in cash and marketable securities. It's a massive war chest.
That's a big number, but it's not just about having cash. It's about generating it, right?
Yeah, exactly. And maybe more telling is their ability to generate it. If you look at their automotive operating free cash flow, that's FCF, the cash left after paying for what they need to maintain the business.
Right, the real lifeblood.
Precisely. For Q3 alone, it was $4.2 billion. That FCF, that's what gives management the breathing room, the flexibility to invest in the future and return capital to shareholders.
Which brings us to buybacks and dividends.
Yep, directly to their disciplined capital return strategy. They clearly have confidence in future cash generation, otherwise they wouldn't be doing this.
So what did they do in Q3?
In Q3, they repurchased $1.5 billion in shares, and they paid out $500 million in dividends. A consistent, pretty aggressive buyback program like that usually signals that management thinks the stock is undervalued.
Compared to its long-term potential, yeah. Makes sense. What also stood out to me, though, was how they're handling external risks, like tariffs.
Good point. Everyone in the auto industry is grappling with trade tariffs, right? Yeah. It's potentially a $3.5 to $4.5 billion annual hit. Yeah, but General Motors, they've already offset roughly 35% of that expected impact.
How?
Through strategic pricing, mainly. And also some proactive supply chain work. They aren't just sitting there taking the hit. They're actively mitigating the risk. That shows real managerial agility.
And you see that agility reflected in their market position too, right? Their U.S. market share.
Hit its highest third-quarter level since 2017. That says a lot about the brand strength, especially for those core trucks and SUVs we mentioned.
And it seems like operational discipline is key here. I saw they reduced dealer inventories by 16%.
That's right. And here's the kicker. They've maintained below-average incentives for 10 straight quarters.
10 quarters.
10 quarters.
Wow. In an industry famous for needing discounts to move cars, that's an incredible streak. But I have to ask, is there a risk they're being too disciplined? leaving sales on the table?
That's a fair question. Is keeping incentives so low the only way to manage potentially softer consumer demand? Or is it just smart business right now?
What does the data suggest?
Well, if you connected it to the bigger picture, the data suggests their current strategy is definitely prioritizing margin over volume. Investors usually like that, especially when the economy feels uncertain.
Okay.
They're essentially proving their demand is pretty inelastic. People are willing to pay up for that Sierra, that Silverado, and this strong ICE performance. It's the critical thing funding the transition to the future.
And that future, that's the big strategic challenge, isn't it? Balancing the current ICE success with the inevitable shift to electric vehicles. How are they managing that two-front war?
This is where their strategy gets really interesting and maybe a bit controversial for some.
How so?
They are explicitly investing in both futures. On one hand, they committed $1 billion to develop their next-gen V8 engine.
$1 billion on a V8 now.
Exactly. This isn't just keeping the lights on for ICE. It's doubling down on leading the high-margin ICE market for, say, the next decade.
So it's basically a $1 billion hedge. Betting the EV transition might be slower or maybe messier than some people think. Keeping the profit engine going until Ultium takes over.
That's a good way to put it. And on the EV side, they're accelerating the Ultium battery platform rollout. And they're focusing heavily on localization efforts.
Why localization specifically?
Well, that's crucial right now. It helps mitigate geopolitical risk, ensures supply chain stability for their EVs as that portfolio grows. Very important these days.
And they seem willing to make tough calls quickly, too. That restructuring charge last August, the $1.6 billion one for EV operations, why take such a big hit if things are going well?
See, that move was purely about being smart with capital. They're optimizing their EV production capacity.
Meaning?
Meaning instead of just racing to build factories for every possible EV model and risking, having too much capacity, which some competitors have arguably done, they decided to restructure. Focus resources only on the models with the highest demand, like the electric Silverado.
So that charge, while it looks bad on the books short term?
Right. It ensures disciplined spending and hopefully prevents much bigger losses down the road if they built stuff nobody wanted.
Okay, that helps explain the nuance around the guidance, because that confused some people, I think. They had this great operational quarter, raised adjusted EBIT and EPS guidance.
Right.
But then the full-year net income outlook was actually revised slightly lower. The top end dropped from $9.5 billion to $8.3 billion. Seemed contradictory.
It does seem contradictory on the surface, but it's really a consequence of accounting for that restructuring charge we just talked about.
Okay.
The raised adjusted guidance EBIT and EPS that reflects the strong operational performance, the cash they're making selling trucks. But that $1.6 billion charge, it's a non-cash expense that hits the bottom line, the net income, immediately.
So the core business is healthier, but the official profit number takes a temporary hit from that strategic EV write-off.
Exactly. So the dip in the net income ceiling is strategic pruning, not operational failure. That's a really crucial distinction for you, the listener.
Still, despite that fundamental strength, we did see the stock drop about 8% during that second week of October. Shows there's still some nervousness, right? Sector risk.
Definitely. Lingering sector-specific risk concerns, especially sensitivity to any negative EV news or sentiment shifts. The market is still a bit jumpy there.
So shifting gears a bit, what about the near-term technical picture? Where does the stock actually sit?
Well, technically speaking, the momentum looks undeniably strong right now. The stock is trading clearly above its key moving averages, the 50-day and the 200-day. That typically confirms solid upside momentum.
And what are the technicals suggesting for the next few months?
The forecasts, based on technical analysis, project a trading range that, could push up towards $85. There's likely some resistance around the $70 mark and then again at $80.
So it looks like a classic momentum play, potentially, as long as those fundamentals hold up. What specific dates or events should you be watching over the next 3 months?
Okay, on the corporate side, the big one is the GM Q4 2025 earnings release. That's currently scheduled for January 23, 2026.
What are you looking for there?
Another upside surprise, confirming continued high margins on the ICE side and manageable EV costs that could easily trigger the next leg up for the stock price.
And before that, anything else?
Yeah, keep an eye on some external technical drivers, often overlooked but important. There's the S&P 500 ETF rebalancing, that's November 5th, and then institutional portfolio rebalancing on December 20th.
Why do those matter?
Well, When huge funds have to adjust their holdings to match indexes or end-of-year targets, it can create significant buying or selling pressure, sometimes unrelated to the company's fundamentals, but it moves the stock. Momentum traders watch this closely.
Got it. And what about rumors, the speculative stuff?
Yes, we can't ignore the speculative buzz. In the auto sector, that's often a prelude to actual news. There are these, well, unconfirmed but persistent rumors floating around.
Like,
we've heard chatter about a potential major joint venture or partnership, maybe in China. That wouldn't just add revenue. It could significantly de-risk their reliance on the domestic market.
interesting. Anything else?
Plus, the technology rumors are always there. Things about maybe accelerating conversational AI in cars or the autonomous vehicle rollout. That could unlock totally new revenue streams eventually.
And dividends.
And given that strong free cash flow we talked about, there's always the possibility, the rumor, that management might review and maybe significantly boost the dividend. That would definitely attract a whole new group of income investors.
Okay, so bringing this all together, what's the overall take?
Right now, General Motors looks pretty compelling. I'd say it warrants a bullish rating, maybe a 9 out of 10, given how the fundamentals and the technicals seem to be lining up.
Why so why?
Because the company seems uniquely positioned right now. It offers potential event-driven upside for shorter-term traders, while also presenting long-term investors with that structural growth story in AV and EV. And it's all backed by pretty consistent, disciplined capital returns.
Okay, so here's a final thought for you to mull over. General Motors is basically asking investors to trust them. Trust that the huge profits from its gas-guzzling V8 trucks will successfully pay for its clean electric future. The real question is, how long can they keep those high margins going on the old tech while efficiently spending billions on the new Ultium platform? Their ability to perfectly manage that balancing act, using today's profits to build tomorrow's business, that will truly decide if they hit that $85 target, and maybe more importantly, if they remain a dominant force long after the ICE age ends.